Hey everyone, welcome back to another video. Today's an exciting day. We finally broke out of that TLT resistance that we were looking at for the past couple days right here. So we were getting squeezed in this wedge between the 20 moving average and this resistance right here, and we finally managed to break out. So now the question is, will we hold and will we make it to this resistance zone that we identified, or is this some sort of fake out and will we roll over? So on the 10-year bonds, we went down by quite a lot, 5.65%. We're now at 1.17% on the 10-year bonds, which is extremely low, even considering all the stuff that we knew beforehand about why inflation is not such a big deal. It's still pretty shocking to see it fall this far this fast. So I just want to go over some news. I usually don't like covering news, but I thought today was particularly important. So we know that the trend was usually due to a collateral shortage and a deflationary backdrop in the global monetary system, and a slowdown in global growth and a dollar shortage. Right, all of these things would contribute to yields falling. Right, and that we haven't really been doing a lot of money printing. QE is not inflationary. And that we've had these fake out reflationary trades after each recession for the past 20 or so years, or some would argue even for the past 50 or 60 years. So looking at the news, we see that this could have been due to the debt ceiling. So basically, we have approached our debt ceiling, so that means we can't borrow any more money. The federal government cannot borrow any more money to pay for its liabilities, meaning that the Treasury for 3 months, right? I forgot where it was. Yeah, let's see. So people are definitely confused. Well, if we do not manage to solve this problem, then the United States would default on its loans. All people all around the world would sell their U.S. Treasuries, so yields should go up. But today we did the exact opposite. And my argument is that it is a collateral shortage. So let me just go to this specific sentence that I saw. Where did it go? So basically what they said was that for 3 months, the Treasury will no longer be issuing debt. And I just want to show that sentence to prove that. Okay, well, I can't find it, but somewhere in this article, you can believe me, somewhere in this article basically said that the Treasury will no longer be issuing new debt for 3 months. And during that time, they'll do some things where they allow the federal government to borrow or spend money without the Treasury issuing bonds. So basically, I guess you could say this is actually printing money. So why isn't the markets panicking, right? Why aren't yields going up higher? Because not issuing debt for 3 months means that the collateral shortage we are having is even worse. No more T-bills being issued. So that means the T-bills that we have right now is what we got. So what we saw earlier today was that everyone all around the world, everyone that needs to fund themselves with T-bills, anyone that wants to get a loan or do some repo or anything needs T-bills all around the world to it basically allows money to cycle through a lot of different institutions in the global monetary system, the global banking systems, et cetera, right? This is the oil in the economic machine, right? Collateral for loans. So if all of a sudden there's not going to be any more T-bills for the next 3 months, everyone's just buying, getting as much as they can as possible, because now the uncertainty is, okay, will the U.S. default on its debts? Probably not. Probably this issue will be solved. The probability of that happening is certainly a lot higher than us defaulting. Okay, so then knowing that, everyone's like, okay, well then I got to get as much of these T-bills as possible. So basically, that's what we saw here, right? Everyone just buying as many bills as possible, everyone getting as many bonds as possible, because 5 and 7 years can now be used as collateral, and they can be exchanged for cash with the reverse repo through the Fed. Yeah. So basically, this is just what I think. I haven't seen the new stuff coming out with. I'm sure Steve and Meter and Jeff Snyder and Emil will come out with stuff explaining this kind of stuff, and definitely see some stuff on Twitter or Real Vision. But for now, this is just my opinion of what is happening. This just was the trigger. And I also want to explain that this news didn't come out of nowhere, right? This is an article coming back from July 23rd, so like a week ago. And this article basically explains the Treasury, right? This isn't some surprise news. The markets, see, that's the beautiful thing about markets, right? Over here, the markets were just being a little unstable, right? And on a technical level, it was waiting for some sort of trigger to break out of this, right? And now this was the trigger, this announcement today of what they will be doing. But the markets have been pricing this in since like a couple weeks ago, and so that's like the beauty of the markets, right? Like looking at it from a technical standpoint, you could kind of tell that I don't know what's going to happen. I don't know what news is going to come out, but I do know that we are going to go higher or we're going to break lower. So that's why technical analysis is so important, because it prices in future news. Like something will happen in the future, we just don't know what yet. So that's why technical analysis is extremely powerful, right? So another thing that I wanted to get into was so now what, right? So now what are we looking for? Well, we know that there is a strong, powerful resistance zone over here. So we can expect our profits, which right now is around $900 for an open. I don't really look at the day. Despite this, right, on a $4,000 position, and then we got this much, it might seem like a lot, but it's actually not. Because the only time I will say I've made money is when I actually do make money, when I actually sell out of my position. This P&L right now is meaningless. It doesn't mean anything until I sell it. And also, you do remember that I YOLO'd $420 worth of TLT calls that expired last Friday. It was 10% of my position that was either going to go like 5x or go to zero. So you have to remember that despite this, subtract $420 because those options just expired. So it's pretty nice. I can see that definitely implied volatility has gone up. Let's bring that over here. So yeah, applied volatility has shot up, and it seems that we could definitely be going higher. Who knows? Maybe this could completely reverse. So basically, combination of technical analysis. We knew a wedge was forming. We knew it was going to break out, up or down, and we have this news that basically makes a collateral shortage even worse. And I think that everyone's trying to buy as many bonds as possible because they need it to fund themselves, and they need to lend and borrow money from each other, and et cetera, et cetera. And Yellen knows this, right? Yellen knows that this will make the collateral shortage even worse. So we'd like to know what she's thinking. So anyways, I hope you guys enjoyed the video, and if you liked it, please like and subscribe, and I'll see you guys next time.